You're now live.
We are live. Okay. Do I have to click got it that we're being live streamed? All right. Um, we're going to continue this afternoon. I believe we are going to get testimony from some nationally recognized folks in tax policy that were recommended to us and testified to the other body. So that we get some background in all of this. And then we can have some committee discussion about where we want to go with this and what else we want to hear. So our first witness is Janelle Kamenga. I hope I didn't massacre that, from the Tax Foundation. Janelle, welcome to Senate Finance, such as it is on Zoom. And why don't you just tell us a little bit about your background and then tell us what you think about this proposal.
Sure. Thank you so much for having me. I'm really excited to talk about Senate Bill 53. I think there are a lot of things going on. I'm excited to talk about them. But as you said, my name is Janelle Kamenga, and I'm a policy analyst with the Tax Foundation. For those who might be unfamiliar with us, we are a nonpartisan tax policy research organization. Since 1937, we've advocated for tax codes that are simple, neutral, transparent, and stable. And if I can get going on Senate Bill 53, I will say a couple things. So this did start out as a single issue bill, but it's become something of a grab bag, as I'm sure you're all aware. Some of the proposed changes, like eliminating the throwback rule, are definitely worth considering because they are pro-growth, but other parts of the bill do reduce the efficiency of the tax code, like the increase in the alternative minimum tax. There's no clear reason why the concepts should be combined because they do seem to work at cross purposes. There's a lot to discuss, so I'll just be addressing the parts that were added after the initial Senate bill was passed. So one of the bill's components is an increase in the number of brackets in the alternative minimum tax and an increase in the dollar amounts for the required payments for that. This is problematic for a number of reasons. The very nature of a corporate income tax is to land on corporate income. So there are naturally going to be some years where companies don't owe taxes because they're posting losses or they're carrying forward net operating losses from previous years. An alternative minimum tax undermines this purpose because it applies to businesses even when they have a very limited ability to pay. So the required payments, even in this bill, they are relatively small, so they keep the burden moderate. But I just do say these things because it's important to be careful about leaning too heavily on taxes that don't have any connection to actual business profits. And losses aren't the only reason that companies might not owe corporate income taxes. Certain tax incentives can also cause burdens to dip to zero or even result in tax refunds. And if those tax credits are accomplishing what the state wants them to accomplish, then it would be counterproductive to work against them with an AMT. If the credits aren't delivering the results you want them to, then the real answer, instead of an AMT, is just to reform or repeal those tax credits. Another provision in the bill is the change from three-factor apportionment to single sales factor apportionment. This is a topic that has gained a lot of traction in states in recent years. As you all probably already know, states can use three factors in their apportionment formulas. That's property, sales, and payroll. But they can choose what weight those factors have as long as they are internally consistent. And all that internal consistency means is that states need to set up their system so that if every state were to adopt the same apportionment formula, then it wouldn't result in double taxation for any company. Now, that leaves the states a good bit of freedom in how they want to address apportionment. Historically, states weighted the three factors evenly, but there's been a big shift to relying on only the sales factor in recent years. A three-factor apportionment does have a greater connection between the taxes paid by companies and the benefits that those companies receive from the state. But single sales factor does have the pretty attractive effect of outsourcing some of the tax burden to companies with less of a physical footprint in the state. Now, this happens because under single sales factor apportionment, businesses can increase their in-state investment without seeing their tax burden rise. And thus, that doesn't discourage in-state operations. As more and more states have shifted to this treatment, it's completely understandable that Vermont would want to make this policy choice in order to compete with the rest of the country. But what's even more impactful than that is the provision to eliminate the state's throwback rule. And while the proposed switch from the Joyce to the Finnegan rule is related and significant, I'll just be focusing on the impact of throwback rules in general. Many of you are likely already familiar with how throwback rules work, but in case anyone isn't, I will briefly walk through the theory because it's not the simplest thing ever. We've just discussed how states have the freedom to apportion corporate income based on sales, property, and payroll, but Public Law 86-272 adds another stipulation. It says that a business must have some kind of physical presence in a state in order to be taxed. So just making sales into a state is not enough. But under this system, if there's a company that has all of its marketing and sales offices in one state, and it only ships its products to customers in another state using a common carrier, then that company won't have nexus. This creates what's called nowhere income, and this is where throwback rules come in. So if a company is located in Vermont and it sells into another state where it doesn't have nexus, then those sales are thrown back into the numerator of Vermont's sales factor. It's really important to note that throwback rules are only asking whether a business is taxable in another state and not whether it's actually taxed. So if this Vermont company sells into a state without a corporate income tax like South Dakota, then that throwback rule doesn't apply since South Dakota did have the legal ability to tax the company, but it chose not to do so. This also holds true if a company has no liability in its destination state because of tax incentives. So that income still can't be thrown back just because the destination state decided to forego taxation. Now, all of this does sound really attractive to states looking for revenue until you realize that throwback rules can create a really uncompetitive business environment for certain types of businesses. In some cases, throwback rules can create levels of taxation that are so high and unattractive to businesses that the outmigration they create can more than offset any revenue gains they would have received from capturing that nowhere income. So to kind of show how this works itself out, we can picture a company that is located in Vermont and it sells into 2 additional states where it doesn't have nexus. So if the sales income is equally distributed between those 3 states, that means that the company's Vermont tax burden is actually 3 times what it would have been if the state didn't have a throwback rule, because the income it's taking from those other 2 states is thrown back to Vermont and that's being taxed. Throwback rules try to consolidate tax burdens from many states into a single state, but this could be avoided by just shifting business operations. So if our company in Vermont suddenly picked up and moved to one of those 2 states instead, or if it just adjusted its distribution process, so now it has nexus in those other states, its tax burden would reduce by about 2/3. And because of that, it's easy to see why companies are willing to make changes like this for those significant tax reductions. And this isn't just a hypothetical situation. Businesses really do take note of throwback rules. In one study, profit sensitivity rates to throwback rules were shown to be about double the response to property tax abatements and investment subsidies. That means that throwback rules tend to reverse any benefits provided by tax incentive packages and then some. In other bad news for throwback states, the economic literature suggests that throwback rules don't expand corporate tax bases in any meaningful way, and they don't actually increase overall state revenue, even though they do significantly increase burdens for very specific taxpayers. In fact, in states with high enough taxes, the imposition of a throwback rule can actually reduce revenues, which is exactly the opposite of what you'd want that to accomplish. Those in support of throwback rules see them as a way to correct the problem of taxing anything less than 100% of business income. But there's no clear reason why, if a business has untaxed activity in one state, why another state should be able to tax that activity. Throwback rules are also inequitable because they ultimately land on a relatively small number of businesses. And those small number of businesses also tend to be small businesses. Those bigger businesses with more resources will be able to restructure themselves to avoid that tax burden. But if businesses don't have that flexibility, then they will be stuck footing the bill. So to sum all of that up, throwback rules are non-neutral, they're uncompetitive, and they're ultimately counterproductive. They can lead to double taxation, they often land on small businesses, and they don't actually increase state revenue significantly, if at all. Now, as a rule, tax cuts don't pay for themselves, and we're very aware of that here, but repealing throwback rules may very well be the exception. If the state repealed its throwback rule, there would be some short-term transition costs, and those should definitely be considered. But because of the outside effect that throwback rules have on business decisions, the small revenue loss would be absorbed into future growth from new or retained businesses. Vermont wouldn't see any long-term loss, and it could even see a long-term gain by becoming a more attractive business destination. Now, while it's slightly removed from these corporate tax issues, including software as a service in the sales tax base is in this bill, and it's also worth discussing. At the Tax Foundation, we are generally supportive of expanding the sales tax base to include services. After all, an ideal sales tax is one that falls on all final consumption. States in general are very far from this ideal, mostly because of historical accident. They created their sales taxes in the 1930s when goods made up the majority of the economy, and that left services mostly untaxed, and that has remained to today. But as services make up a larger share of the modern economy, moving towards a broader sales tax base is important. But it's even more important that the base be the right size, and that means taking care to avoid taxing business inputs. So this definition of software as a service in the bill is broad enough to run into that issue because it levies a tax on all use of software as a service, regardless of who's paying for it. So yes, there will be a lot of individuals that will be taking advantage of cloud services and paying for that, but a significant portion of the people that will be spending on cloud services are going to be businesses, which means that this is an intermediate business transaction. If you tax business inputs like this, it increases costs for businesses, and the cost has to be made up somewhere. If the company who sees these increases in costs is mostly competing with businesses in Vermont, then they might pass those costs on to customers. But if they're mostly competing with out-of-state businesses that aren't facing the same cost increase, then they'll have to absorb the cost themselves, possibly by slower wage growth for workers or less investment in the state. In that way, in-state companies are penalized by including this in the tax code. This would undermine the state's competitiveness when compared to states that don't tax software as a service. In its amended form, Senate Bill 53 makes several changes to business taxation, some of which are definitely more attractive than others. As the legislature deliberates on these issues and potentially makes changes to the legislation, I would definitely encourage lawmakers to focus on the repeal of the throwback rule, which undermines Vermont's tax competitiveness and drives away businesses without doing much to generate revenue for the state. 2 states actually repealed their own rules earlier this year, and that's a trend we're likely to see continue in the coming years. Thank you so much.
Okay. Now, I thought when you started, I heard you say that we aren't going to do the cloud tax until our next meeting. But I thought your testimony was that in general, you liked that, but then in the end, you had some concerns about its impact on business to business trends.
Yeah, so to be clear on that one, we generally like broadening the sales tax base as much as we can, but because cloud services are so often used by businesses, just including that in the tax code without any stipulations for that means that you're taxing a business input, and we see that as a problem.
Okay. Okay. Committee questions. Senator Brock. Randy, you're muted.
Perhaps it's already been done, but do we have a copy of your written testimony?
I can get that over to you if you'd like.
That would be helpful to go back and through. You've given us a lot of information. I think I've digested a good bit of it, but if you were to summarize very quickly, what are your recommendations regarding the bill that's in front of us? Or the proposal
absolutely.
In front of it, specifically?
I mean, I think there are some competing elements here. Like I said, the alternative minimum tax, raising that is not the most competitive thing you can do. And that does cut against some of your other priorities. But if I were to just focus on one thing, I would definitely drive home that eliminating the throwback rule is actually a very good thing for the state. And if nothing else gets passed, or if a lot of other things get cut, And even if everything here gets stuck right now, I think that repealing the throwback rule should definitely be something that Vermont thinks about in the future, because it's really going to help make the state a better business environment.
Okay. What about the proposal to go to the single tax and move to Finnegan? Do you have an opinion on that? Because this
Okay.
committee has, this committee's first look at this proposal. So any thoughts you have would be helpful.
Yeah, absolutely. So on the shift to single sales factor apportionment, we don't have extremely strong opinions on that because both have their merits. But if we're just talking in terms of making your state look more competitive, then single sales factor is probably a better way to go, just because so many states are going in that direction, which means that, like I was talking about before, if you're only looking at how much sales a company has into a state, you're not looking at how much actual like property they have and any in-state investments and that sort of thing. So if you only look at sales, then you're outsourcing some of that tax burden to people who have a very small footprint, but a whole lot of sales into the state. So if you change a single sales factor, then businesses in the state will get, at least they won't be discouraged from investing more in the state. And that is definitely an attractive thing to do.
Okay. Committee questions? I'm not seeing any. Computer keeps shutting off my agenda. Okay. No questions at this point. All right, thank you. This is helpful. All right, and next I have Michael Mazarov. So Michael, you are a senior fellow at the Center on Budget and Policy Priorities. Tell us a little bit about yourself and then see if you can help us understand this proposal.
Great, thank you, Madam Chair and members of the committee. I, excuse me, also appreciate the opportunity to testify this afternoon. I am a tax policy analyst at the Center on Budget and Policy Priorities, where I've worked for about more than 20 years. Before that, I was the Director of Policy Research at the Multi-State Tax Commission. And my work at the center, which, like the Tax Foundation, is a nonpartisan nonprofit research institute, mostly focuses on state business taxation. So I'm going to limit my comments to the 5 provisions of the proposed the amended House, the House amendments that are directed at state corporate tax policy. So I will just summarize them by saying that I strongly support 3 provisions, 3 of the 5 provisions of the bill, namely increasing the corporate minimum tax, switching from the Joyce to Finnegan method of combined reporting, and eliminating the exclusion from combined reporting of so-called 80-20 corporations. And I oppose or would recommend against 2 provisions of the bill that have also been addressed in the previous testimony, repealing the throwback rule and switching to single sales factor apportionment. So starting with the corporate minimum tax, the reality is that many corporations can take advantage of loopholes in state corporate taxes, particularly when it comes to artificially shifting their income to foreign subsidiaries. Vermont's a combined reporting state, but it's a water's edge combined reporting state, which means you're completely vulnerable to international income shifting, which is a really serious problem. And corporations can also zero out their corporate tax liability by taking advantage of multiple tax incentives that perhaps the state policymakers didn't contemplate. The fact that the state policymakers have enacted tax incentives in the past may mean that they think individually they are a good idea, but they may not have intended when they enacted them that corporations could completely zero out their tax liability, particularly by taking advantage of multiple tax incentives. So I think there is a good rationale for having a corporate minimum tax. Many states do. 4 states, to my knowledge, New York, Oregon, Connecticut, and New Jersey, have corporate minimum taxes along the lines of what's proposed in this bill, namely a sort of tiered minimum tax based on increasing tranches of gross receipts. and a couple other states have those minimum taxes as high as is proposed in this bill. And then I'd also point out that your neighboring state of New Hampshire has an entire second business tax, the so-called business enterprise tax, which is a value-added tax that also serves as a corporate minimum tax. So other states, what's being proposed here is not unprecedented, and I support this provision of the bill. The second provision is switching from the so-called Joyce to Finnegan methods of combined reporting. Those names come from California tax cases of a couple decades ago, which sort of first raised this issue. An increasing number of states are switching from the Joyce method to the Finnegan method. Colorado did just this summer. And basically what these two choices involve is how you're going to deal with combined groups where some out of state, some of the subsidiaries of the corporate group that are taxable in, if there's one corporation that's taxable, subject to the income tax in Vermont, and there's other members of the combined group, some of which are taxable in the state directly and some of which aren't taxable in the state directly because of Public Law 86272, which the previous witness just explained. If the Finnegan method basically says that we are going to, if any one member of the group is taxable in Vermont, we are going to consider all members of the group that have sales into Vermont to be taxable. And the whole goal of combined reporting is to result in tax liability for the corporation that's completely independent of how the corporation chooses to divide itself up into a parent and subsidiaries. And that objective can't be achieved if you're using the Joyce method, because it's still going to mean that some members of some unitary members of the combined group are not going to, their sales are not going to be factored in their Vermont sales are not going to be factored in computing the tax liability in Vermont of the corporation that is subject to tax. So the Finnegan method is really the only method that achieves the intended goal of combined reporting, that the tax liability is not affected by how the corporation chooses to divide itself up. And when you're using the Joyce method, corporations have opportunities to reduce their tax liability in the state, to engage in tax planning by putting certain activities that are selling into Vermont into separate subsidiaries that don't have nexus in the state because they're protected by this unfortunately obsolete federal law. So as I said, an increasing number of states are going to Finnegan, and I think I support that aspect of the bill. And I would say that it's especially important to switch to Finnegan if you do go ahead and enact the bill in total with the switch to a single sales factor apportionment formula. Because if you're doing that, you're really saying we're going to minimize the tax liability of our in-state corporations and try to maximize the tax liability of out-of-state corporations selling into Vermont. And if you maintain the Joyce method, you're not going to be able to fully achieve that goal, because there will be lots of subsidiaries with substantial sales in Vermont that are nonetheless not going to be included fully included in the combined group. The third provision that I strongly support, and that the previous witness really didn't address, is the proposal to eliminate a current exclusion in your combined reporting laws that says that unitary subsidiaries that are in the that are incorporated in the United States but have more than 20% of their property and payroll abroad, or more than 80% of the property and payroll abroad, are not to be included in the combined group. And this provision would eliminate that. And that is an incredibly important provision, because it has turned out that exclusion, which unfortunately a significant number of states still have, has been a loophole that the multinational corporations have absolutely driven a truck through. What they're able to do is basically create a subsidiary that might have, one employee abroad and a little bit of office furniture and a rented office abroad, and therefore that one employee and that little bit of office furniture means that 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 subsidiary has more than 80% of its property and payroll abroad, and that opens up all kinds of opportunities for them to engage in transfer pricing. A lot of the tax shelters that you shut down by adopting combined reporting, like the notorious kind of Delaware holding company trademark shifting loophole, these companies can recreate by shifting their income into one of these US 80/20 companies. And there are lots of documented cases of this. I'll send the committee an article from way back in 2007 that was in the Wall Street Journal about how Walmart did this. They basically created an 80/20 company abroad that the only activity of which was holding employees who were procuring the merchandise for resale in the United States, and they shifted all kinds of profits into this 80/20 company. So that's a really important loophole closing measure that I support. And I think you've already heard a little bit from Bruce Fort this morning about that. And I trust that Bruce will talk about it in his testimony following mine, but he's really the expert on this. He's recently written a whole article on the way that 80/20 companies have been used to avoid corporate taxes. So those are the three provisions that I support. The two that I oppose are repealing the throwback rule and switching to single sales factor apportionment. Now, the throwback rule issue will not be nearly as significant if the bill is passed in total and shifts to a single sales factor formula, because if you adopt Finnegan, that will mean that if any entity in Vermont is shipping goods, like a manufacturer in Vermont is shipping goods to another state, and any one of its subsidiaries is taxable in that state, then sales won't be thrown back to Vermont. So it's not that significant. It will be less significant if you, in fact, go to the Finnegan method. But nonetheless, the reason why states have throwback rules, as the previous witness indicated, was to eliminate. It's basically a cooperative mechanism that the states adopted in cooperation to ensure that corporations would not have nowhere income. And the reason why they have nowhere income is because of this unfortunate federal law that says that selling into a state is not sufficient without physical presence to obligate the corporation to pay corporate income tax in the state. So the states got together and developed the throwback rule as part of the standard apportionment formula that was created back in the 1950s to address that. It's a second best solution. I granted the best solution would be to automatically have the authority to tax corporations if they're making substantial sales in the state, but that's the obsolete 1959 law that states are stuck with. So they got together and they said, we are going to all cooperate by saying that by enacting this throwback rule. And to this day, a majority of states, by my count, of the 45 states with corporate income taxes, 26 of them still have throwback rules or closely related throwout rules. And that includes your neighboring states of Maine and Massachusetts, New Hampshire, Rhode Island. They're all throwback rule states. This is just a basic issue of ensuring that corporations don't have nowhere income in states where this law is resulting from having sales in states where this law protects them. And I think, it's a basic fairness issue. Individuals don't get to have nowhere income. If I live in Vermont and I work in New Hampshire, Vermont is going to, and New Hampshire doesn't have an individual income tax. Vermont is going to tax all of my income, regardless of where it's earned. So individuals don't get to have nowhere income, but because of Public Law 86-272, corporations do have nowhere income. That's unfair, and that's why the majority of states still to this day have throwback rules. And finally, single sales factor apportionment. Yes, I understand the theory that having property and payroll in the formula increases the tax liability of corporations if they increase their property and payroll in a state, but that's what the corporate income tax is premised on. that we impose a corporate income tax for the benefits that corporations receive from state services. And the more property they have in a state and the more payroll they have in a state, the more they're benefiting from state services. And that's why they have a higher tax liability in proportion to their property and physical footprint in the state. So that it's consistent with why we have a corporate income tax. And the fact of the matter is that, yes, this has proliferated over the decades as a supposed economic development incentive, but it has in fact not turned out that way at all. The corporate states that have adopted single sales factor formula really have nothing to show for it. The initial research that was done by an economist named Austin Goolsbee purporting to show that this was a great economic development incentive was really rebutted in 2014 by a follow-up study by an economist named David Merriman, who extended the analysis more currently and found that there was no statistically significant gain in states adopting single sales factor. I do this exercise every year where I rank the states with regard to their success in retaining manufacturing employment. And if you rank the states in terms of their rate of loss of manufacturing jobs over the last 20 years, the states that have had single sales factor in place for that entire period, if you look where they fall in that ranking, they fall evenly across the ranking. There's no real world correlation between whether the state has been a single sales factor state and whether in fact it has achieved the purported goal of the policy of being an incentive to increase or retain manufacturing jobs in the state. So it's just basically, I oppose Vermont's adopting this, notwithstanding admittedly that other states are going in this direction, because it's just simply a needless revenue loss that's inconsistent with kind of the theory of why we tax corporations and how we tax them. And it won't really achieve anything in terms of job creation. So I understand the theoretical argument, but in the real world, it's simply not played out that way because state corporate taxes are too low to really be a major factor in state investment decisions. So thank you for giving me this opportunity. I'll be happy to answer any questions.
Okay, committee, any questions? Senator Hardy.
Thank you, Madam Chair. Mr. Mazeroff, thanks for your testimony. The previous witness mentioned, and I forgot to ask her the same question, but looking at tax credits and potentially reforming tax credits as a means rather than having increasing the minimum sales tax or minimum corporate tax, sorry. Do you also think that there's some opportunity at looking at those credits? And if so, which ones would you suggest?
Well, I have not really looked at the kind of range of corporate tax credits in Vermont. So I would have to, take a look at them before I could really kind of identify specific opportunities. I mean, it's absolutely true that states layer on lots of tax incentives that are often, don't pass a cost benefit test, are often excessively generous. I mean, in particular, there's states in particular have excessively generous research and development credits in many cases, so much so that in lots of states, there are literally hundreds of millions of dollars of kind of carry forwards in these credits just because they've been excessively generous. So yes, there's always an opportunity to look at economic development tax incentives. And like the Tax Foundation, we're kind of skeptical that in many cases that they pass a cost benefit test. But I don't think that's the only justification for corporate minimum taxes. I mean, as I said, even leaving tax incentives aside, there are still lots of tax avoidance opportunities that corporations can take advantage of, particularly related as all this attention to the Pandora Papers and the Panama Papers before them, just in terms of identifying lots of international tax avoidance opportunities. And I think those potential for companies to zero out their tax liability in that way is an independent justification for fairly robust corporate minimum taxes, quite apart from incentives.
Mm-hmm. Well, regardless, I mean, I would be interested to hear from you or the previous witness or any of you on ideas about tax credit reform as well, if they're necessary, because there is evidence that some of them don't do what we may have intended them to do. So, thank you.
I'd be happy to look at that and get back to the committee about that.
Thanks.
Okay, Senator Brock.
As I asked the previous witness, I wonder if you haven't already done so, if you have a written summary of your testimony that you could provide the committee so that we could digest it in a little more detail later.
I have not drafted it, but I'd be happy to do so and send it to you.
That would be very helpful. Thank you very much. One of the things that you mentioned was about minimum taxation of corporations. And I think the reason, as I understand, that you raised it principally was because there's so many cases that we read about in which our corporations have large amounts of income and are not paying taxes. But I wonder, on the other hand, that there are lots of corporations that are going broke, that don't have any money and that don't have any income. And I wonder about the fairness of charging them taxes, income taxes, when they in fact don't have any income.
Well, I mean, I think one can make a reasonable case that corporations are still benefiting from public services in transitory periods when they are not profitable and can reasonably be asked to pay something to the state for the benefits they're receiving from the state, even in years in which they're not profitable. You know, it's also true that, you know, in many cases, this is just a transitory, these are just sort of transitory effects. And, you know, I mean, there are lots of states, we impose lots of taxes on businesses in years in which they're not profitable, again, because we believe that they're benefiting from whether it's police and fire protection, you know, for their property, even in a year in which they're not profitable. So I think this bill is the proposal in this bill is structured in such a way that small businesses have a really minimal tax liability, but I don't under the minimum tax, but I don't think it's unreasonable given the fact that in most cases, you know, the companies that are going to get hit with the heaviest minimum tax under this provision are probably they're probably going to be subject to the minimum tax because they really are profitable and they've managed to zero out their liability with incentives or with tax planning, rather than that they're truly not economically profitable.
Any other questions? Senator
Well, I guess
Scribe?
I follow up on that question for a moment. You know, I hear the assertion. Is there any evidence based on objective studies that this is a problem that affects most large corporations that report low revenues or low tax net gain?
Well, I mean, there are lots and lots of opportunities for companies to engage in income shifting, even in combined reporting states. I mean, again, you know, if this is less of an issue if you go to Finnegan, but as I explained, there's lots and lots of opportunities for corporations to minimize their tax liability if you're a joint state, even as a combined reporting state. So, you know, I mean, I can send you a study after study about international income shifting by large multi-state, multinational corporations that Vermont is completely vulnerable to, because you're, you know, like every other combined reporting state, you're a water's edge combined reporting state. And there's, you know, very aggressive international income shifting. Study after study has shown that. That's why the OECD this week just agreed that, on a international corporate minimum tax, because they, countries around the world recognize that international income shifting is a significant problem.
Okay, you did just touch upon something I heard, which is that internationally, countries are imposing a minimum corporate tax. The goal being to eliminate tax shelters, or some of them.
Well, I would say it's more accurate to say that the proposals that are under consideration now, and that the OECD countries, the 140 countries just agreed to, is really just basically aimed at kind of recouping some of the revenue lost to international income shifting. I mean, it's hoped that maybe it will disincentivize the income shifting to begin with, but it's mostly intended to just sort of recoup the revenue loss. But the U.S. has had an international corporate minimum tax in place since the 2017 federal tax bill. And I can tell you, because I've been deeply engaged in this around the country, the business community is fighting tooth and nail against states conforming with the federal corporate minimum tax, and they've mostly succeeded. I don't know what the situation is in Vermont, but they want to protect their ability to reduce their state corporate taxes using international tax avoidance techniques, and they've been very active in preventing states from conforming to this minimum tax. And I expect they'll ramp up their activity even more if the United States increases the federal minimum tax, which is what they're obligated to do as part of this new agreement.
Senator Sirotkin.
I just had a very basic question. I think thank you for your testimony. I think you made some passing reference that in general, corporate income taxes are not huge factors in terms of economic development and where companies locate, et cetera. I don't know if you know or the chair knows, what are we bringing in presently under the corporate income tax in Vermont, and how big of a chunk does this proposed $20 million loss represent?
Graham just popped up, Mr. Mazarov. I think he may have it at his fingertips.
Yeah, I think it was in the
Right.
fiscal note. I read it this morning.
Yeah. Graham, you want to refresh us?
Yeah, the updated July 2021 forecast for the corporate income tax for fiscal year 22 is $175 million. And for fiscal year 23, it's $193 million. So a $20 million impact on, say, fiscal year 22 is, about 10-ish, somewhere around 10. Yeah.
Thank
Okay.
you.
But we did, sometime in the discussion this morning, that 20 became 10.
Yeah. So
Was that
after
with the imposition of the new minimum tax?
the minimum plus the Joyce to Finnegan switch, so that's
Okay.
that's what the net after all of the corporate tax changes are made. The 20 million is just the single sales portion.
Okay. So if we do the other two things, we do away with half of it. And then we've got 10 million to make up, which I gather is why one of the reasons that the cloud taxes came attached to this. So, okay. Senator Sirotkin, any more questions? Committee?
No, thank
Okay, well, Mr. Mazarov, thank you.
Thank you for
This has
having me.
been helpful. We are definitely getting to see two sides of opinion on this one. And I hope you'll let us, when we get back into session and continue to work on this, be able to call on you again for your expertise, because this is our first swipe at it, and we will get a lot more detailed as we work through. So thank you. Okay, our next presenter is Bruce Fort, who we met this morning. And you were from the Multi-State Tax Commission. Bruce, tell us a little bit, what is the Multi-State Tax Commission? And just give us your thoughts on this entire proposal.
Madam Chair, members of the committee, thank you very much. Appreciate the opportunity to talk today. Second time, sorry about the first time to kibitz on
First
your
time
meeting.
was fine. It was no fault.
So the Multi-State Tax Commission was formed in 1967. The number of states banded together. One of our main reasons for being formed was there was a push, a federal preemption push to preempt states from imposing corporate tax. And Public Law 86-272 that happened a few years before that was sort of part of that. And so the idea was if the states banded together, reformed corporate income tax, and got more uniform, that we could convince Congress not to preempt state taxation of corporations. So that was one of our main founding goals. We've expanded over the years, and part of our goal now is just to try to encourage better tax policy for not only corporate income tax, but for sales and use taxes affecting any business doing interstate commerce, if you will. And I am a senior counsel with the commission. I've been there for about 14 years. Before that, I was counsel with the New Mexico Tax Department for about 16 years. So I've been in the business for a long time. And Vermont is a member of the Multi-State Tax Commission. And part of it, we have what's called a compact, a multi-state tax compact that Vermont has never joined. But the central part of that compact was all the states agreed to adopt a single statute, the Uniform Division of Income for Tax Purposes Act, UDIPTA we call it. And Vermont has most of the provisions of UDIPTA in your own laws. You've varied over the years from some things. And so part of that is a 3-factor formula, property, payroll, and sales, that may have made more sense back in 1957 when the UDIPTA was drafted, when we had more of a manufacturing economy. And so a number of states over the years have reformed that. They've gone from 3-factor to more heavily weighting the sales factor, and then finally to eliminating the other 2 factors entirely. The MTC used to have as a policy position that the 3-factor formula should be adhered to by all the states in the interest of uniformity. If states are not uniform, that presents more opportunities for tax arbitrage, if you will, game playing between states. But over the years, as a number of states have moved to single sales factor, the Multi-State Tax Commission is now neutral on the position. We just don't have a position. And so speaking first on the sales factor issue, since I think that's the big economic piece of the revenue estimate here, it sort of depends. We heard testimony this morning. It sort of depends on the nature of the business as to how well that fits. And if you are a service business, if you're one of the big high tech companies, a single sales factor might make a lot of sense because the single sales factor might make a lot of sense because these are consumer facing businesses. That's how they make their money. On the other hand, if you're a manufacturer, a single sales factor might make less sense. So it is a trend. Most states are going towards single sales factor, or at least more heavily weighting the sales factor. But it is not a revenue gain for most states. Mr. Mazeroff is correct in that the states did not see some gigantic revenue growth. I want to talk to you mostly here today about the change from proposed change from the Joyce to the Finnegan method. And it sounds fairly obscure, but so you are a combined filing state. You have been since 2007. You worked with the MTC in 2007 on going to combined filing. It's a major improvement for how states tax corporations, because it mimics the federal consolidated group. It's more or less the federal consolidated group. But the difference between Joyce and Finnegan is fairly significant. In In the Joyce method, all of the unitary corporations, if you will, the US-based corporations are in the group. However, the sales factor only includes those members of the group that have nexus, that are not that have unprotected activity, if you will, in Vermont. And you heard this morning testimony about Public Law 86272 that says that you cannot tax a out-of-state corporation that only makes sales into the state if all they have in the state are salesmen and salespeople. And so that's been a huge carve out. And the Joyce method was designed to not offend Public Law 86272. So the sales are in the denominator, but they're not in the numerator. So you have a company selling into Vermont that has 10 subsidiaries. Perhaps only one of them is doing services in Vermont. The other 9 are doing sales of tangible property. The sales of all that tangible property remain in the Vermont denominator, but they don't go into the numerator. So you can imagine how that sets up the potential for some real distortion of income. And so it was when Vermont adopted combined filing in 2007, there was a concern that the Finnegan method might violate that 86272. Under Finnegan, you basically treat all of the corporate group as a single entity. And so if 86272 doesn't apply, if any one of those entities is doing services or is doing something that has exceeded Public Law 86272, for instance, having a store in the state, then all of the entities are considered to be part of that taxpayer group. And so it just is much, much less distortive. Since 2007, in fact, in the 2007 tax year, a number of tax cases came out and said, you know what? The Finnegan method does not violate 86272. Treating all the companies as if they were a single corporation doing business in your state does not violate 86272. So it was I think the revenue differences will be significant for Vermont for doing 86272, changing from Joyce to Finnegan. And I think it'll be a significant improvement and will really eliminate a lot of the sort of game playing that we see where companies shift their sales operations into an entity they know is not going to have nexus in your state under 86272. So I think that's a huge positive reform. The commission, by the way, remains neutral on the matter, although I did a hearing officer paper that is available at www.mtc.gov. And so we have a number of white papers on this topic. And the clear import of the white paper was the Finnegan method makes better math sense. It just makes better sense from an algebra standpoint. But we have not endorsed one or the other. We now have endorsed both. And the MTC just came out with a model Finnegan method that the legislature could consider. We tried to cover every small issue from net operating losses and everything else to that. So it's on our website there. Again, that's the main thing I want to talk about today is a major, I think, significant tax reform to go from Joyce to Finnegan. As Mr. Mazeroff says, it is something which other states are moving towards as well. And I think that that's going to be an improvement. The second thing is, which I mentioned here this morning, is the, and I'm sorry, I just lost my light. So I'll have to, sorry to be looking like I'm in witness protection here. The second thing I want to talk about is the so-called 80/20 companies. And I mentioned earlier that the federal tax system is designed to work on a domestic basis, a domestic water's edge basis, and encourages transfers of property, transfers of income, if you will, between domestic entities. And it does that so that there'll be more efficiency because the federal government can tax a Delaware company as easily as it can tax a company in Vermont. So to the federal government, it makes sense. They're all going to be filing on a single consolidated return. The 80/20 company carve out was intended to, it was sold to the states, if you will, as this idea of we want to protect true international companies that just happen to be incorporated in the US. And it hasn't worked out that way. As you can imagine, the 80/20 rule in Vermont says 80% of your payroll and 80% of your property have to be overseas. Well, intangible property is not part of the property calculation. So you could have a company with one employee overseas, that would be 80% of your employees, since you only have one employee in the company, and one desk and $1 billion of intangible property. And that company would be considered an 80/20 company excluded from Vermont return. It would be very difficult for Vermont to pick up that income. And there are two examples. Michael mentioned that Walmart had done this back in the 1990s. There are two much more current examples. I mentioned one this morning. Frito-Lay company, or Pepsi company, put their Frito-Lay operations into an 80/20 company, and the Illinois Independent Tax Tribunal just this summer said, we don't think that's a true 80 company. We think this is kind of a sham transaction you engaged in. We don't think those overseas employees really work for Frito-Lay. We think it's kind of a sham transaction. And the second one is Target Corporation, and Target did it several years ago and has an 80/20 company in Hong Kong with 5 employees. And so these 80/20 companies can really distort income. They put in all of the Target trademarks are now owned, all the US Target trademarks are now owned by this holding company doing business in Hong Kong. So that case went up in front of the district court in Colorado just last year, or about 2 years ago. And the Multi-State Tax Commission, we also audit corporations. We sent an auditor to testify in that case. So as you can imagine, it's pretty easy to transfer your intangible assets to one of these 80/20 companies. It is a tax-free exchange. There's no recognition of the income. And that intangible holding company can then charge a royalty to the US tax base. They can charge a royalty to the Vermont Combined Reporting Group. So that's pretty significant. And we don't know how much revenue Vermont loses on the 80/20 rule. I wasn't really able to find very good revenue estimates. I just did a paper on that, which again is also on our website, www.mtc.gov. And I didn't put a revenue estimate in that paper because I just couldn't find a good one. But I think it's substantial, and I think you heard testimony this morning that might be 5% of your tax base is lost to these 80/20 companies. That doesn't seem unlikely to me. I might put the number at higher than that. But again, we just don't have good revenue numbers for that. Minnesota did away with their 80/20 companies a few years ago after they had a court case involving HMN Financial. It was a bank. They transferred all of their assets, all of their real estate assets, if you will, the paper to that, to a Cayman Islands holding company, had a single employee, and the Minnesota Supreme Court said, with this law on the books, there's nothing you can do to stop that. And so the Minnesota legislature about 5 years ago said, well, we have to fix the law. They eliminated their 80/20 companies. So those are the main topics I wanted to talk about. I do agree with Mr. Mazeroff that the throwback rule, it's not a great economic rule, but it is, I think his description of it as the states bound together to try to say, how can we cooperate to make sure that we don't create nowhere income? That was the purpose of the rule, and it has worked fairly well. I think it becomes less important as you go to single sales factor with market-based sourcing, with the Finnegan method, and you've now got market-based sourcing. And I think as you go towards the Finnegan method, then the issue of throwback becomes less important to your state, but it's still out there. And the MTC, it's still part of UDIPTA. It's still something the MTC supports. But I do agree with the Tax Foundation's testimony this morning that it's something that the states are moving away from. A number of states have abandoned their throwback rule. I also agree with what Mr. Mazeroff said earlier, which is that corporate income tax is such a small amount of the overall expenses of a corporation that we shouldn't put too much emphasis on economic development principles. That it's really probably the last thing they look at when they're trying to come up with, do we want to move to Vermont? They're looking at your unemployment rates, they're looking at your property taxes, they're looking at your workforce, your quality of life, all of those great things that Vermont has. And the corporate income tax is probably going to be a footnote in their analysis. So I do agree with Mr. Mazeroff on those things. So that's it. I'm not prepared to talk about your minimum tax. The MTC doesn't have a position on minimum taxes. And I think that covers a bit about all of it. And I'd like to stand for questions, Madam Chair.
Thank you. That was very helpful. Committee questions. Okay, Senator Bray and then Senator Hardy.
Thanks, Mr. Fort, for coming back again. And just a quick question on the, when we were discussing earlier, the throwback rule, I think the case that was illustrated was there are 10 states where there are sales taking place. One of them doesn't tax based on sales. And so there are revenues being foregone by that state. But what is from a sort of fairness point of view, why should it matter to a state whether or not another state where that company operates collects or does not collect a corporate tax based on sales in that state?
Thank you, Senator. I'd like to, I think I can clear that up. The throwback rule would not apply in that situation. It only applies where a company does not have a taxable presence in the destination state. So and it only applies to sales of tangible personal property as well. So if the company in Vermont were selling into New York and New York did not tax that sale for whatever reason, did not tax that corporation, had chosen not to tax it, and there are about half a dozen states that have no corporate income tax, that sale is not thrown back. So that sale would still be, and let me use Delaware as a better example, since they don't have a corporate income tax on most corporations. So a sale from Vermont into Delaware, where Delaware has chosen not to impose a tax, or has chosen to impose a very low tax, or not tax that particular kind of transaction, put it in their sales factor, that would not be thrown back. It's only a throwback if that company has no nexus in the destination state or is protected by that federal law we mentioned earlier, Public Law 86-272. And and again, under the Finnegan method, if there was some other, if that company had no presence in Delaware, but it had some other company, some affiliated company that did have a presence in Delaware, then it would not be thrown back, because the company as a whole, the family of companies, if you will, would have exceeded 86-272 in Delaware, so it would not be thrown back then either. So again, the adoption of Finnegan really reduces the importance of that throwback rule, but it doesn't apply at all. There is no throwback if the state to which the sale is made has just chosen not to tax that corporation, doesn't have a corporate income tax. That's not a throwback.
Okay, thank you. And one other quick question. This is probably another, I don't want to open up a whole new area of conversation, but in various committee meetings in the past, we've talked about the applicability of a sales tax. Well, I'll leave that alone. Different conversation, but I'd love to come back to it.
Okay.
Okay, we may get to that the next meeting. Senator Hardy.
Thanks, Madam Chair. Thank you, Mr. Fort. My question, you mentioned several times white papers that you had written. I am on the Multi-State Tax Commission website and I cannot find where the white papers are on your website. Do you have more direction?
Sure. It may take me a second here.
Yeah, I think maybe you could email that URL or whatever it needs to be to Faith, our committee assistant, and she can get them all out to us. So you don't have to spend your time right now.
That'd be great. Thank you.
Senator Hardy, the article I did on 80/20 companies and encouraging states to get rid of them, that should be on our, unless someone has pushed me off the front page, that should be on our front page of our website. And if they push my article off the front page, well, I'll maybe it was time. It's a few months ago, but the other stuff you'll have to go through the uniformity page. You'll see a drop-down menu, and we have a section called the Finnegan Project there. But I will send to Miss Brown, Faith Brown, links to both of those articles.
Okay, I see Anatomy of a Domestic Tax Shelter. Is
there
that
you go.
Okay, great. Thank you.
Okay. Any other questions, musings at this point? Okay, if not, thank you, Mr. Fort. And this has been helpful, and I hope you'll be willing to come back and talk to us once we start doing a deeper dive. This is just our first look up, and I see Senator Pearson has come up with a question.
Yeah, I wonder if Mr. Fort is able to stick around or interested in our discussion about the language in the feminine hygiene products tax, because I think it's related to your organization. And so it's, I guess, as much a question for you, Madam Chair.
He is welcome to stay if he would like to.
Senator, Madam Chair, Senator Pearson, I'd be happy to stick around for that, but it has not been a focus of mine, but the commission does have lawyers who work with the Streamlined Sales Tax Commission every day, but it's I'm more on the income tax side, but so I haven't actually taken a look at that language.
Well, if you could just give your colleagues a heads up that we may be sending them a letter, that we don't need to take your time. Thank you.
Okay. Thank you.
I think the question is, how do we change the language? You might help us understand the ins and outs of that. Okay, any other questions? If not, thank you. And our next witness is Bill Driscoll, who's from the Associated Industries of Vermont. Mr. Driscoll, welcome back. We haven't seen you in a while.
I know. Thank you, Madam Chair and committee.
Yeah, I'm sure you're just so sad that we haven't seen you in a while.
I know. I didn't shave for the occasion, but it's still a very special day for me. So, thanks for the record. Bill Driscoll with Associated Industries of Vermont. As you said, Madam Chair, I very much appreciate the committee starting to take some time on this issue. I know it's something that we've discussed on the House side for a number of years, but we haven't had sort of the opportunity to really take this issue to you folks much in the past. So it's, again, I'm glad that you're starting early, as it were, to take a look at this. Obviously, as you might imagine, there's not a lot I can say that isn't a bit repetitive from a lot of the very good testimony that you've gotten so far. But I will just sort of try to go over some highlights, and then I'd be happy to take any questions or otherwise sort of take notes about what we may want to follow up with you about as you move forward. Our approach to this issue, and this has been the issue of sales apportionment has been an important one for us for a number of years. And it really is sort of in the context of, what kind of policies can we have that support and reward, really sort of incentivize or reward employment and capital investment in the state. And we believe that this is an important part. It's not a silver bullet or the only thing, but it's certainly an important part of that overall priority. As you've heard, moving to a single sales factor, because of the distribution of sales for manufacturers generally, particularly in a small state like Vermont, it would encourage manufacturing and other companies that export goods and services in this state. And those tend to be very high value companies in terms of the state's economy. When we originally started advocating for this a number of years ago, it wasn't as widespread in the country. And so it really was really kind of an effort to create an advantage for Vermont, which we don't have a lot of, but it would have been, an advantage to create that sort of tax treatment here. More and more, as more and more states adopt this, it is becoming a bit of, let's not be, one of the few states remaining that don't have a single sales factor and therefore have that sort of disadvantage. So that's becoming more and more concern, although it's still something I think that would create an advantage for the state if we were able to adopt it. And as you certainly got a taste today about how there are disagreements among folks in terms of how much of an economic benefit it may or may not provide. I think without question, though, it does provide it does provide something. As someone was talking about earlier, some people take the attitude of every bit helps, and frankly, that's true. When you're trying to encourage new businesses to come to a state, or for businesses to stay here or to grow here, there are many factors. Just like no one factor may be a silver bullet. By the same token, you can't say that individual policies or programs don't matter just because they're part of a larger picture. I'm sure there'll be opportunities to discuss and debate this a lot more. I would just say, kind of put it very simply, to say that moving to a single sales factor doesn't matter at all or won't help at all is somewhat equivalent to saying that it doesn't really matter how high our tax rates are. It doesn't really matter what different costs of doing business are in the state. And I just simply don't accept those premises. The significance may be different from company to company. You're maybe talking about, how do you move the odds or the chances of a good or bad outcome. But nevertheless, it would be a positive factor. It would be part of an overall picture. I think another thing that's sort of come up, obviously, the biggest companies with the biggest incomes have the biggest tax liabilities, and those, can often capture all the attention or draw most of the attention. But there's nothing about income apportionment and the weighting of the sales factor that is better or worse for a large company or a small company. It's really more of a factor of how much of a company's income is based on exporting goods and services. And if they have tax liability, the benefits of a single sales factor would be there for those companies, whether they are big or whether they're small. It's all relative. So it is a good sort of broad-based sort of tax policy in that sense. And apart from the sort of economic arguments or the sort of policy arguments in that sense, there is something to be said for having just simply good tax policy in terms of simplicity, fairness, consistency. And moving to a single sales factor ticks a lot of those boxes as well. If you're looking to do, which Vermont and most states are, to apportion income of companies across multiple states, the most direct analog for that is, in fact, sales. Sales very much align with and reflect distribution of income, much more so than property and payroll. In fact, you can make a lot of arguments how property and payroll don't really have much to do with how income should be divided up amongst states. So there's that sort of design or principal benefit. And then also, we just very recently moved to market-based sourcing for the taxation of services, which is effectively a single sales type approach. And so this would also be making our treatment of taxation of companies that produce tangible goods more in line with the way Vermont has moved on certain intangible goods. So it has that sort of principle or design benefit as well. Obviously, the question of revenue impacts is a legitimate one, and folks, have been talking about that so far. I think, as the commissioner noted, it is important not to look at this this provision, but and frankly, not even this bill itself in isolation. So I just noted. That we made a relatively recent change to market-based sourcing for certain services. And I think that the revenue impact of that has not yet been fully realized or calculated, but I think it is estimated to be quite, a meaningful increase in revenue. And so, if you're looking at offsetting impacts, I think it's important to keep in mind that, there's more going on than just this bill in terms of addressing those kind of issues. And also, I certainly am not in a position to dispute or necessarily disagree per se with joint fiscal or the tax department on trying to estimate the impact. I think it is fair to say, though, that as I recall, and certainly folks can talk about this more, but when looking at the couple of states that have tried to estimate what the impact was proportionately on their revenues by moving to single sales in recent years, the estimate for this bill here is I believe it's on the higher end of the impacts that other states saw. Now, I know that there are some reasons for that in terms of just the makeup of our state and the ones we're comparing ourselves to, but it's just to say that I think, I think there's reason to believe that the revenue losses may not be as big as possibly laid out here in their own right. And then again, there's a lot more offsetting revenue issues out there as well that should be considered. And just another thing too, and with all due respect to Mr. Kvet, I'm not criticizing this point. Maybe it's actually helpful that he brought it up. But he raised the question of revenue and put it in the context or the sense of, say this, for the sake of discussion, say this costs, $10 million. Is this the best use of that $10 million? And I think that I appreciate him sort of raising that to the point that I think it's important to realize that that's not really the right question. Just as I was saying before, there's no one factor that drives recruitment or retention of businesses. There are many things. And if we're looking at our general posture toward economic development, you're looking at a large number of policies and programs in various fields that are aimed toward those goals. And they are not all going to have the same sort of cost benefit profile, but that doesn't mean that they're not all useful in and of their own right. We don't have only one policy for economic development priorities. We have multiple policies. And so I think it's important to kind of keep that in context as well. I do want to sort of focus also particularly though on the throwback rule. That's, I feel that's a very important part of the overall package, especially in the context of moving to a single sales factor. The throwback rule really is a very arbitrary and even capricious tax policy in its own right, but it also conflicts very much with the move towards single sales factor. We can go into this at greater length, but we can come up with all sorts of scenarios that sort of illustrate that. If you take two hypothetical companies and they have the exact same size, exact same income, everything about them is identical, except that one has more sales in some states and the other one has more sales in some other states. Because of the throwback rule, those two otherwise completely identical companies could have radically different Vermont tax liabilities because of the throwback rule. And that's just fundamentally bad tax policy, we would submit. Similarly, a company could have identical performance year over year in terms of income, but because the distribution of their sales might shift from year to year across a different mix of states, year over year, they could have very different Vermont tax liability. And again, that kind of inconsistency and sort of lack of rationality, I would submit, is a problem with the throwback rule just in general. And I certainly could get into more of the fairness issues about states thinking that they want to go after what's so-called nowhere income. But again, we can talk about that more if folks are interested. But on just the consistency front, just again to reiterate, if you do accept the value of a single sales factor and you want to move in that direction, then there is a consistency problem with the throwback rule. The very premise of a single sales factor is you look at income generated in your state, not out of your state. And obviously the throwback rule is completely contrary to that. And if we do move toward single sales factor, because the throwback rule distorts only sales and not the other factors, the negative impacts or the issues with the throwback rule become much more exaggerated as you move toward a single sales factor. Most states that have a single sales factor do not have a throwback rule. On some of the sort of the related or some of the other provisions, the whole Joyce to Finnegan shift, we don't have any objection to that. I think to the extent that some of the advantages of moving to a single sales factor is that you have a relative shift of tax liability from being reduced on some in-state companies and increased on some out-of-state companies. To the extent that Joyce Finnegan rule shift kind of reinforces and facilitates that shift and addresses some of the revenue concerns associated with the overall change. We think that's we're supportive of that being part of the package. When it comes to the 80/20 rule, it's kind of a legacy when unitary combined reporting was adopted and the issue of water's edge. In my understanding at the time, there was still a lot of concern about what kind of litigation you get into with certain companies. And in order to avoid that, the simplicity of the 80/20 rule was just sort of a way to kind of sidestep what could otherwise be some costly disputes over water's edge issues. My understanding that has become less of a concern in terms of how we can really determine, those kind of issues and appropriately assign tax liability. And also, frankly, at least for our purposes, we've tried to identify or get any feedback from any companies that might actually be using that rule, and we haven't actually found or heard from any yet. So we're not sure, at least from our organization's perspective in terms of manufacturing, whether that's really a very common practice or a practice of concern. Certainly to the extent that this would treat those companies the same as everybody else is treated in terms of apportionment, we can support that kind of consistency and fairness from that view. Our only biggest concern was again, because of the uncertainty of who these companies are and how much of a change in tax liability they may experience. I think just a question of potential sort of tax shock or sort of transition issues was something that we've raised as a potential reason to maybe go a little bit slower on eliminating that rule and trying to get a better idea of who's really going to be impacted and how. And that's still, we would still be supportive of maybe just going a little bit slower on that, not to not do it, but to get a better awareness of what some transitional issues might be. But that's not a pressing concern with the overall package. We're supportive of the overall suite of changes in terms of the single sales factor, the throwback rule, Finnegan and Joyce, and the 80/20 companies. Beyond that, the alternative minimum tax, we are concerned about that. There is frankly the principle of taxing gross receipts as opposed to net income, as has been brought up. When you do that, you can end up taxing a company that doesn't actually have net income And that's, there's a fundamental issue of principle on that. And then, although most of the brackets would remain relatively modest, I think that if you look at especially that top bracket and the $100,000 tax liability, that does really stand out quite a bit from other states. There aren't many other states that have quite as big a hit as that on these companies, and that raises issues of perception, even if it's just perception, but of competitiveness, between Vermont and other states, and that could be a concern. So we do not support the alternative minimum tax change as it's written. There may be other approaches that we would find acceptable, but I think that one needs some more thought, I think. So those are the big issues.
Okay, thank you. Mr. Driscoll, we've heard that different sectors of business are impacted differently by this. And can you give us just a breakdown as to how your membership, what sector they're in? I mean, I know there's an associated general contractor, so are you 50% manufacturing? Is it physical? Is it service industries? Just a general, who do you represent?
Sure, and I'm not sure if I could. We're definitely not only manufacturing. I don't know I can't think of the breakdown off the top of my head, but in terms of sort of advocacy, particularly on this issue, it is primarily from the perspective of and for the benefit of Vermont's manufacturing sector. In terms of who really benefits from this, it's really, it's kind of in the name, as it were. It's all about what kind of companies have a distribution of sales that's predominantly out of state. And that is definitely squarely manufacturing, again, particularly in a small state like Vermont. But really any company that has goods or services where their sales are generated, out of state, they will have some degree of benefit. And then the degree of benefit would depend on what the proportions of that are. There may be companies where they have half of their sales out of state. There may be a lot of companies, particularly manufacturers, where most years, maybe all their sales are out of state. So it is not exclusively manufacturing, but that's really one of the primary benefits. And that's, as a organization representing the interests of Vermont's manufacturers, that's why it's been a high priority for us.
Okay, thank you. Committee, any questions? No? Okay, up, Senator Bray.
Yeah, quick question for Mr. Driscoll. And that is, we talked a little bit earlier today about not just this moment in time, looking at this potential change to tax policy, but looking, 1, 3, 5, 10 years out. So as a member of an organization that's looking at, for instance, growing manufacturing, do you have anything else related to corporate tax for the manufacturing sector without taking us too far off this particular bill and topic?
Well, yes, I would say this is by far and away one of the sort of both, even though it may not sound simple, but it is a fairly simple, clean, and broad approach that in terms of benefiting manufacturing as a sector, and then again, obviously other exporters of goods and services. So this is one of the better ones to do. Another one I'll just mention, just because you guys talked about it a bit this last session, and maybe it can be revisited again, is the expansion and clarification of the sales tax exemption for machinery and equipment. And that'd be very helpful. Again, and it's very similar themes. In other words, you're really kind of rewarding or incentivizing investment here in the state. So I'll put that one out there.
Great, thank you.
Okay, thank you. Any other questions? Not up. Senator Hardy.
Thanks. Thanks, Mr. Driscoll. Just, I sort of playing off a little bit of what Senator Bray just asked, but, you said kind of every little bit helps in terms of, tax changes or incentives, credits, economic development programs for businesses or specifically for manufacturing type businesses in Vermont. Have you ever surveyed your, done any kind of analysis or survey of your members to get any idea of what helps the most? I just don't buy that all of these factors go into a decision about making citing decisions for companies. There are things that kind of must float to the top, like an educated workforce, or a skilled workforce must be something that really, really matters, I would imagine. And sort of like, what's the ranking, and do you have that data?
So not recently, but I think, as you might hopefully not find terribly surprising, it's different for different companies. It's not. I don't think you can say this is always the most important thing. It really depends on the circumstances and the needs and challenges that an individual company might have. But in terms of certainly broadly speaking, workforce quality is definitely a very important one. Historically, it's been one of the few actual advantages that Vermont has had. We have a lot of costs of doing business issues, but we've had companies that, I don't want to name a specific company, but I can think of one off the top of my head that actually left the state and was so disappointed with the workforce of where they moved, they came back. Having a high quality workforce can go a long way in countering a lot of the other sort of challenges or disadvantages that we have. Unfortunately, however, that advantage is kind of atrophying over time, where sort of skills development and other sort of things in the education track have not really been keeping up with the increasing demands of sort of modern manufacturing, and so it's becoming harder to find skilled and qualified workers. So it's kind of analogous to that in terms of like what are some other areas that would be helpful for manufacturing and other companies too. But it's the perennial issue of workforce development and training. The Vermont training program is something that has been thought about as being very helpful for those companies that have been able to take advantage of it. So that's certainly an issue. I mean, I could
just say, if you're constantly saying all of the above, we want all of the above. We want tax breaks, we want tax credits, we want the list goes on. We're not going to be able to have the revenues to pay for excellent training programs and education programs, and so it would be really helpful to really hone in on. This is the thing that could really make the difference, rather than all of the above. That's not helpful. So I guess I would just encourage you to really get a better picture to share with us about what does make the difference. And I realize it's different for every company. I do, but there's got to be trends that you can point to, rather than just telling us every little bit helps, because we have to be able to make those pros. We have to be able to weigh the pros and cons.
Absolutely. On that short list, I would definitely put corporate tax changes that we've recommended today.
Okay. Any other questions? I'm trying to get, because we are, for the first time, overtime, on to Bram Kleppner, who has been with us, I think, since the very beginning. And Bram, we just wanted to get input from the tax commission. Did you look at these issues? You chose 3 topics, and corporate income tax wasn't one of them. And just thought you might talk to us. And you're coming back next week to talk to, because when we're looking at the cloud tax, which is another one that's been there for a decade, and I think at least every 2 years the House brings it up. And so just wondering what your thought process was in this.
Thank you, Madam Chair and members of the committee. It is nice to see you all again. And on the subject of the issues in this bill, we looked at some of them and we did not look at others. We did not talk about the throwback rule and we did not talk about the 80-20 rule. So I have no comment on either of those. On the corporate minimum tax, we didn't discuss it, but I do just want to appreciate Senator Brock's question about the potential effect on small businesses. And I really don't have any sense for how many small businesses there are in the state that are not pass-through entities and that are subject to the corporate minimum tax rate, who might actually in years of no profitability or net loss find that burdensome. So I appreciate the sensitivity to that question. In fact, the member of our commission who was most knowledgeable about corporate taxes was Steve Trenholm, and he could unfortunately not be here today. However, he and I and former Commissioner Brighton did have a chance to exchange some emails on this subject. So I will share with you the content of those. With in our report, we didn't address any of these with sort of a primary recommendation. We did make a recommendation that if the Multi-State Tax Commission does adopt Finnegan, that Vermont also do so. As we heard, the Multi-State Tax Commission has not adopted Finnegan, but now sort of supports Finnegan and Joyce both as approaches equally and neutrally. The comment in our report was if Finnegan is adopted by the MTC, conformity with the MTC as a member is important. And then we went on to say, provided the switch is either revenue positive or at minimum revenue neutral. I think what we heard is it's not likely to be much revenue positive, but maybe neutral. So, I would say now that we are where we are in 2021, it's a little bit hypothetical, but I suspect the commission would support the move to Finnegan for the reasons that you have heard today. On single factor, we again did not issue a strong recommendation in our report. However, it is consistent with sort of our general thinking, and as we heard, consistent in terms of simplicity and perhaps fairness, probably fairness. I don't know enough about it to say whether there's an effect on sustainability of going from a 3-factor to single factor on sales. Commissioner Trenholm did write to say, on the single sales factor apportionment in the proposal, it is consistent with what many other states are doing. It is also advantageous to Vermont businesses since eliminating a 0 property factor and a 0 payroll factor for multi-state businesses not based in Vermont will put Vermont businesses on a more level playing field. It will also eliminate the apportionment of more than 100% of taxable income between the states because many states have gone to single sales factor. I think those are our thoughts.
Okay. Okay, thank you. Committee, any questions? Not seeing any. Thank you very much. This has been helpful. I think we have a lot to think about.
Yes, you do. And thank you for thinking about all of these complicated and interrelated issues and how they interact with one another. It's a lot, so thank you.
Okay, thank you. So committee, we have one other item on the agenda, which is the multi-state tax agreement. Which is also known as the super sales tax or super tax is part of that. And I know Abby is here. And Senator Pearson and Senator Hardy, we sent a letter, if my memory is correct, asking to change the definition of feminine hygiene products. Is that where we are, or what we've done, or who can give us an update? What's happening?
I'd be happy to do that, Madam Chair.
Okay.
So last session, actually, as we were just speaking about S53, that was originally the bill to exempt feminine hygiene products as defined by the streamlined agreement from sales tax.
Oh,
that was
they
taken
needed
out.
a vehicle. Okay.
Correct.
We
That-
put it on miscellaneous tax, right?
Yeah. So it did pass, just not on S53. It passed
Right.
on the miscellaneous tax bill. It took effect on passage, which was in June, I believe. Sorry, let me pull up just had the language in front of me. And during the discussion on the floor in the Senate, there was some concern about the language implying lack of cleanliness, that it was hygiene products. The language that was used is what is required as part of the streamlined sales agreement. So Vermont took that wholesale and created the exemption. There is a letter that has been drafted but has not been sent to the agreement's governing board. There is a process to request a review of the definition, and Streamline does have a whole process to go through to amend definitions that would require all of the member states to approve a new definition, any changes to the agreement. That happens regularly, and there is a director it's Craig Johnson, who is available to help walk Vermont through that process. So Vermont is a full member state of the agreement. So Vermont does have a vote for any definitional change to the agreement. So that's the status update. The exemption was passed in the miscellaneous tax bill, and there is a letter. I can share that if the committee would like to see that. I'm just pulling up to see when it actually took effect, but I believe it was July 1st. I'm sorry, I should know off the top of my head.
Okay. Well, maybe, yeah, if we can just see, I assume we are recommending a change, not that we have a specific, if I'm remembering, wording for the new definition.
So
Are
maybe
we just
Senator Hardy
requesting
could,
that they redo it, or are we, I thought we were sending them specific wording.
I don't believe we had come up with specific wording unless you had, Abby. I don't see your letter on the website yet, but you did email it to everyone, I believe, at some point.
Yes,
Yeah.
I can share that if the committee would like.
Okay, and I think Senator Bray has a question.
Yeah, my recollection is that we talked about menstrual products, but from whom would the letter come? Would it come from the committee? Because I know a number of us were all interested, and I don't know if it's helpful to have a letter from the full committee or interested members of the committee, or if it traditionally just come from the chair. How does that part work?
I think it can work any way we want it to.
Yeah, I think the pro tem was also interested in this issue too.
It's signing on.
Whomever.
So Senator McDonald, you're looking.
If it can work any way we want it to work the same way it works in other states, do we not? And if so, who can tell us what the text of our letter should be?
So the text of the letter is, and I can pull that up now to show you, is requesting that the governing board change the definition, and then all of the states that are signatories would need to update that's part of why it's a governing board committee process.
So
all of the states would have to agree.
So we set out in the passage of the bill to have other states that currently have a similar practice to change the way that they see it and to do it our way, or did we err?
Not by law.
write it in a way that would have us simply blend in with the other states?
The law that was passed is what other states do. There was nothing passed in the miscellaneous tax bill that requested a change or required a change.
It has nothing to do with the taxation. Under the streamlined sales tax agreement, we all have to agree to the same definition. So soft drink is a soft drink is a soft drink in every state, and we can't
Understood.
exclude.
Understood.
So this is just asking to change the definition. And it's just the wording. It's not what's included in the definition. It's simply the wording of the definition. We find the old wording old, somewhat pejorative.
Would you like me to share the
Yeah.
section just so
And
you
who
can
has
see?
joined us? RLC.
Just before you share that, are we now actively participating in the uniform taxation with other states?
Yes.
Well, it's not it's the definition.
so-
Vermont can choose to tax it or exempt it. And
Yes.
currently-
Are we, have the goals of the bill we passed been put into practice? Are we
Yes,
no
it took
longer
effect
taxing?
July 1st. That's correct.
Thank you. So now we're seeking to help our colleagues in other states edit the definitions that they've worked by since the program began.
Yes.
That's what we're seeking to do?
Yes. And we,
Oh,
our
okay. Well,
bill, our bill
Kind
has
of
the
stymied on all this
existing
talk about
definition.
not knowing what we're trying to do. Okay,
We're trying to ask them
thank
to
you.
change the definition.
Well, Madam Chair, could I
Okay, I found out. Richard Cram has joined us from the Multi-State Tax
Yeah,
Commission. And I believe he is who Mr. Fort sent us, has more expertise in this. So, Mr. Graham, welcome.
Thank you.
And have you got anything you can add at this point?
Madam Chair, I'm
Yes.
sorry to jump in, but
Nope.
I want to make sure we're precise here. We passed a law that complies with the multi-state agreement.
Yes.
We're no longer taxing these products.
Right.
The language, we're not looking for a change of the definition, which a few people have said. It's just that the language is rather outdated. And so the notion was, when people read it on the Senate floor, they said, why are you using these terms? It's not the 1940s. And we said, well, we'll be glad to kind of communicate that. So this is not changing policy. It's not changing definitions. It's just kind of inquiring of, and maybe urging that we update the language. I think that's a more precise way and maybe is a little less confusing.
We're not adding or subtracting anything from the definition. We just would like to have the wording of that definition be a little more sensitive to modern values. Is that?
Modernizing.
We're modernizing. All right. So we have gotten as far as we have written a letter which has not been sent. And that letter does not include a suggested new definition or wording. I would think, if we're going to do this and have it come from the Senate, we're going to have to wait until January to take action. We could send it from this members of this committee and have us all sign on. We could have it come from members of the Senate and just have it go out in an email, and anyone that wants to sign on could, which might be, if you want to do this quickly. But I also think it would be helpful for us to suggest some wording. Otherwise, that just gives the commission something to work off of, and they can say yes, no, but just to say, would you change the wording? Isn't, if I were getting it, I might not. I think we need to tell them how we would like to change the wording. So I've got Senator Bray and then Senator McDonald.
Thank you, Madam Chair. Yeah, I agree with the offering suggested language, because it's a lot easier for other people to respond, and everyone likes to edit. Few people like to start from scratch. So let's put our best foot forward and see what happens.
Okay.
They may just like it. They may come up with something else.
So Senator McDonald.
Agreed, Madam Chair. Some of us have been working on this for 35 years.
That
And
was the tax, not the
5
definition.
days or 70 days or 90 days isn't going to be the end of the world. And perhaps someone who is more modern than those of us who've worked on this for 35 years can suggest language that would be appropriate and
You
helpful.
have been victorious, Senator. After 35 years, it is not taxed. Senator Hardy, I know you've given this a lot of thought. Do you have something to help us?
Yeah, so thank you, Madam Chair. And Abby has a letter that she wrote, and she includes in it, I don't know if Abby, you want to share it or whatever, or if everybody has it in front of them, or if we can get it on our website or whatever, but she includes the current definition in her letter, and also talks about the sort of concerns that we had as a Senate when we passed this. And I think that the switch is actually quite easy based on my knowledge as someone who's been using these products for over 35 years. It's feminine hygiene products as used in this subdivision. Feminine hygiene products mean tampons, panty liners, menstrual cups, sanitary napkins, and other similar tangible personal property designed for feminine hygiene in connection with the human menstrual cycle, but does not include grooming and hygiene products as defined in this chapter. So it seems to me like what we're asking them is to get rid of the whole term feminine hygiene products and perhaps use the term that we used when we were talking about this bill, which was menstrual products, and just say menstrual products.
So if we could draft a letter that just says that we would ask you to change the title.
Just replace feminine hygiene products with menstrual products, I think.
That would be really simple and probably give us the best chance of getting it passed.
Abby and Ann, do you think that covers it?
I do. What do I know?
I can do a strikeout and underline like it were draft language. I would definitely, you didn't mention trying to change grooming and hygiene products because that's its own definition and triggers a whole bunch of other things. So I think there would be two places to replace the sort of catch-all feminine hygiene products to become menstrual products, and then other similar TPP designed for use in connection with the human menstrual cycle to take out that other feminine hygiene reference.
Exactly. I think it's pretty simple and straightforward and covers the basis for what sort of made a few of us cringe when this bill was reported on the floor. And, you know, Senator Pearson was in the unfortunate role of having to explain, well, we had to use this definition because of this tax agreement. And
it is what it is.
We're kind of backed into this corner. So if we can send this from the whole committee and get it out now, that would, I think, be the best if everyone's in agreement. I think this was a unanimously supported bill in the committee. It doesn't change anything we did. It just changes it updates the language. And perhaps Mr. Cram can explain to us to whom it needs to be sent or whatever, if he has information that might be helpful.
Mr. Graham, any suggestions for us at this point?
Just a little background, it's always a kind of a formidable task to get the streamlined states to change a definition, because the question that comes up in the other states is, well, do we have to go back and amend our statutes now? We adopted this definition. So it just kind of a warning. It could be a lengthy process, and it'll take some real active involvement. If you get other states kind of on, pushing, recognizing that, hey, the language needs to be updated, that would really help and probably get it moved forward. Because the initial reaction is probably going to be, hey, I don't want to have to go back and amend my state statutes just because of Vermont's issue. So you kind of have to overcome that hurdle. But Craig Johnson, who's the executive director there, would be probably the first one to contact. And I'd recommend you get the Vermont department folks actively involved too. They're the ones that would they would attend the meetings and be involved in the work groups and so on. So yeah, I think executive director Craig Johnson would be the person to start with.
Okay. Maybe at our next meeting, we could see if we could Zoom Mr. Johnson in and talk to him.
I think he'd be glad to do that. I would expect, yeah.
Okay, Mr. Mazarov.
Thanks for recognizing me. Sorry to interject, but I'm not an expert on the streamlined agreement, and I will defer to Mr. Cram and Ms. Shepherd. But my impression has always been that, to some degree, that the streamlined agreement is fundamentally premised on uniformity in the tax policy and not necessarily uniformity in 100% word for word language. And that's why there have been some rulings that have been sought by states as to whether or not they're in compliance with the agreement, and why there has to be, in some instances, a judgment call on that, because they're saying, I mean, it's easy objectively to look in the statutes and see if the wording is identical. If that were the only determinant of whether a state was in compliance with the agreement, there would be no need for these judgments. So I think it may be worth exploring. And Richard, please tell me, but it seems to me that it is not inconceivable that if all you did was change the label and didn't change the effective taxation of any of these items, that would not be found to be out of compliance with the agreement. Am I wrong about that?
And I have to confess, I'm not totally up to speed as what the status is, but has somebody filed a complaint with the committee that looks at compliance concerning this definition? Is that the status right now?
No, we got some pushback when we presented the tax exemption on the floor about how 1940, 50-ish this definition was, and said that we would pursue it. You may well be right that as long as we aren't changing what's taxable, this like 1 or 2 word definition might not be an issue at all. So I think perhaps our next step might be to have a discussion with the chairman and or director, I'm not sure which, and just see if we've got a problem that we need to solve. We may not have a problem.
I'm going to say, usually what comes up is somebody lodges a complaint with the, it's called the CRIC Committee, Compliance Review Committee, and they say such and such a state's out of compliance because their definition doesn't match the agreement. And then there's a process that's gone through to determine whether the committee agrees with that or not. But if nobody's lodged a complaint yet, you're not at that point. So
we can do what we want.
it might be just the question of running it by the streamline folks. And again, Craig
Yeah.
Johnson would be the place to start and say, hey, do you have a problem with the language that we want to use in our exemption? And if they say no, then maybe everything's good.
Okay.
But yeah, if there hasn't been a complaint lodged, you're in pretty good shape then.
We haven't done anything.
Yeah, and there hasn't been a complaint lodged because I mean, we have used your definition. We used the streamlined
Right.
tax agreement, a definition. So there wouldn't be a means by which to file a complaint. We just are uncomfortable with that definition because it makes implications about, the normal bodily functions of women that we do every month, and implies that they're unsanitary and not clean. So we feel uncomfortable with the definition and think it needs to be updated. If we can just do it in our statutes and still be in compliance, then we can take care of it ourselves. But if
Yeah.
that's going to cause a complaint, cause a problem for Vermont, then we need to go about this sort of request to change it in the entire agreement.
Yeah, this is not the same as exempting yogurt covered chocolate from the definition of candy. I mean, that's
Right.
where candy and soft drinks is where we've gotten into issues before. Or maple sugar. So we're not changing the definition. We're not saying that what's taxable in Vermont is different than what's taxable in New York. We're saying we changed 2 words in the title, but it's all. So Senator Pearson, it's good to see your cat survived another year.
So far. Madam Chair, I think we have covered this at plenty of length. I would suggest, Senator Hardy, that Abby just pull in Senator Hardy's idea, and maybe in the interest of simplicity, you sign it and Representative Ansel, or I don't know who should sign it, but I would be sad to learn that we spend too much time worrying about that.
Yeah.
It's not going to the press. It's just going to register, as we said we would on the floor, our concern that this is rather dated and doesn't fit with modern language. So, but I don't think it needs a lot of time, and that would be my suggestion.
Okay, I think if all we really want to do is express our concern, then we can send the letter out. We aren't asking to change anything. We're just, and say in Vermont, we're going to refer to these as menstrual products. And see if we get a complaint or any pushback, or it might be just a good idea to talk to, is it Craig Johnson first?
Yes, I mean, that would, if he says, hey, we don't, if he's got a staff person who really goes over this stuff with a fine tooth comb, and if they don't have a concern with it, then you're
fine.
You're good to go. Yeah.
Okay, so maybe that would be, and I can do that call if you would like, or on behalf of the committee.
Madam Chair, I did reach out to the Department of Taxes because another issue with the streamlined governing board is that Vermont can delegate several delegates. Typically there's a Department of Taxes employee and someone from the legislature, either House or Senate. And they did reach out to Craig Johnson because there isn't currently anyone from the legislature that's on the governing board. So he did provide the process. However, that wasn't with the actual language. So he might perhaps say that it's not, it wouldn't put the state out of compliance, but it might. So I would be happy to forward that letter with the suggested changes, and then maybe he will be able to make the determination that it's
Okay.
not significant enough to require the whole agreement to be amended.
Okay. Does that sound like a plan of action? We send them an advisory letter saying, this is what we'd like to do in Vermont. And is that going to give us any problems? Please advise. Okay.
That sounds good.
Abby, yeah, and I can sign it and give you permission to type my name on it. Or I can come down and sign it, whatever works.
Would that be from the whole committee or just you, Madam Chair, as the chair of the
On
committee?
behalf of the committee, I think. The committee has voted to do it, so that's fine. I will do it on behalf of. And I've had 3 shots, so I can come down to the State House now. And as of tomorrow, I'm 2 weeks out, so I'm good to go. Okay. We got a plan. We're ready to go. We'll be back on the 25th, 27th. And thank you, committee, for helping me change that date on the 22nd. The Extension Service Field Day in Alberg. We'll be doing a ceremony dedicating a lab at UVM to my daughter, and also they'll be displaying her pottery, which will be in the showcase outside the lab, which is in the Jeffords building. But they do have plaques and stuff, and I would like to be there. I thought I might do the last hour. It's November 17th. I have a note from Faith. Faith, you can come on.
I'm here.
You're here. The next one is the 17th.
Yes,
Not, okay.
we canceled next Friday.
We canceled next Friday. That I knew. I didn't think it was that far out. Okay. Then
yes.
we'll be doing the cloud tax. And again, we're going to start with 101. I think maybe, hindsight is always 2020. I'd put more of the kind of outside experts. This is what it is. This is what other states have done before we get into the weeds. And then for some reason, we're not getting a lot of input from the business community, which the last time we did this, we got a lot of input. So I don't know if it's just the word isn't out yet, but we'll work at getting, more business input at this point. So I think that's it. Thank you, everyone.
Thank you, Madam Chair. I learned a lot today.
Yeah, I think we all learned a lot. I'm going to sit down and go through those notes. And,
Yeah. Please don't quiz me.
Oh, no, there was a lot. And again, now you know why we don't play with the corporate tax very often. It makes property taxes seem simple. So thank you all, and we'll see you on November 17th.
Ending